Last week we got quite a bit of alternative economic data. By alternative, I mean out of private sources, not government sources. So let's take a look at that. Early in the week we got ISM manufacturing. Didn't come in very well. 48.7. Last month was 49.1. The expectation was 49.5. I thought we were bringing manufacturing back to the U.S. Apparently not. Employment 46 versus 45.3. Anything under 50 is contraction, so you can think that it looks like this. So it is still contracting, but contracting at a lower rate than the month before, but still contraction. New orders 49.4, up from 48.4, still contracting, but at a slower rate. And prices 58 versus 61.9. Prices still expanding, but expanding at a lower rate. Services, though, different story altogether. Every number blew it out of the water. 52.4 versus 50. The expectation was 50.8. Never mind that. We're going to 52.4. Business activity 54.3 was in contraction last month. 54.3. Employment still in contraction 48.2. But expected to be in worse contraction 47.6. 48.2 doesn't mean expansion. It means that more companies are either lowering their headcount or not changing it, then are increasing it. New orders 56.2. Look at that jump from 50.4. And services, prices 70. Not that bad from 69.4. It was expected to moderate, but did not. The star last week was Canada. Look at this jobs number. Unemployment rate from 7.1 down to 6.9. We've been hearing that tariffs are decimating the Canadian economy, and our unemployment rate went down. Not only that, I want to just impress upon you how big that is. 6.9 from 7.1. Look at the participation rate, 65.2 to 65.3. So the participation rate went up and the unemployment rate went down. More people in the labor force, and if people enter the labor force and they can't get a job, unemployment just goes up. Even if nobody loses their current job, you just have a larger labor force. So you had a larger labor force and a lowering unemployment rate at the same time. Look at the change, right? You will know him by his number, 666. Don't mess with the beast. Canada is an employment beast here, 66.6. This is mixed, though. Full-time had a drop. Part-time had an increase. This is seasonally adjusted, so before you say, oh, well, that's just hiring for Christmas, it is seasonally adjusted, meaning that if last year had the same kind of hiring and this year had the same kind of hiring, it would end up being zero growth because it would be the same as last year. So it is growth over the seasonal bump that you'd normally expect. Average hourly wage is not to be outdone, 4%, up from 3.6. So not only is unemployment coming down, more people participating, more people are getting paid more, and look at that, 666. Back to the U.S., Michigan consumer sentiment, 50.3. The all-time low was 50 in June of 2022. You're 50.3. 5-year inflation expert. I don't know that I believe any of this stuff. This is just asking people, hey, what do you think inflation is going to be? 75. What qualifies you to say that? You asked me. I mean, come on. 3.6 down from 3.9. Expectations, consumer expectations, 49 from 50.3. That's below 50. Current conditions, 52.3, down from 58.6. That's a big drop down. And when you take your expectations and your current conditions, you get your index, depending on the weighting that's used. Inflation expectations, 4.7, a little up from 4.6. But this is Michigan inflation expectations preliminary, and inflation expectations 3.2 down from 3.4. Let's look at ADP and Challenger Grain Christmas. ADP is jobs created, Challenger gray is jobs eliminated. What do we get here? 42,000. And man, did duration decide to walk out the door on this one. TLT sold off and ZQ sold off. The market priced out rate cuts, saying 42,000 jobs. Oh my God, there'll be no rate cuts. I was in North Bay when this happened. I was at a furrier place looking at pelts, buying pelts. Lots of neat pelts, polar bear, wolf, like everything you can think of as a northern animal, they had pelts there. Anyways, I checked the report in the morning, 42. Saw the reaction. I thought, well, that's odd. But you don't trade in the morning, right? You just let it go. Let the market figure out what it wants to do. But about 11 o'clock when I logged in again, I saw April 2027. Never mind 2026. I'm going out all the way to April 2027. ZQ at 96.92. Implied rate of 3.08%. Effective federal funds rate now is 3.87%. 79 basis points of cuts. Over 42,000 jobs created. Yay! Oh, there'll be no cuts now. Oh my God, look at what we're doing. 42. This is where we are. We're screaming and happy for 42. We've lowered the bar so much and we're so desperate for this rally to continue. We've talked ourselves into the idea that 42 is fantastic. Oh my God, we're expanding. So I bought 50 contracts at the April 2027. That implies 3 rate cuts in 11 meetings, with 7 of those being a Trump-led Fed. Does that make any sense to you at all? That's a gift. That is massive mispricing. 42,000. But let's do what we always do. Let's adjust this number for healthcare, because that has nothing to do with the economy itself. And if we scroll down here, education and health services, 26,000. So make that 16. Are you that thrilled? 16,000. Delivered a rebound from 2 months of weak hiring, but the bounce wasn't broad-based. Education and healthcare and trade, transportation, utilities led the growth. For the 3rd straight month, employers shed jobs in professional business services, information, and leisure and hospitality. I think we messed up on this one here. There we go. Let me scroll back out. On this chart here, you can see the growth over here, and you can see it just flatlining at the very end over here, right? Changed by establishment size. The small of the small shed. The large of the category increased. Small 1 to 19 shed jobs, 20 to 49. The larger of the small gained jobs. Mid-size, the smaller of the mid-size lost, the larger of the mid-size gained, and then of course large, 73,000. But again, you take away healthcare and education, because that doesn't tell me anything about the job creating ability of the capitalist economy. Natural resources and mining up 7,000, construction up 5,000, manufacturing 3. That is the bring manufacturing back to America push that's going on. And information, 17,000. We'll see that sort of echoed in Challenger Gray and Christmas. Professional business services down 15, leisure and hospitality down 6, other services down 13. Let's look at Challenger. Job cuts surpassed 1 million. But we're going to modify that for Doge. Doge was about 300,000. That was a very specific act that was not economy related. So if we take that out, you get to about 800,000 that we could say, well, natural flow of the river is about 800,000 on this one. Highest October since 2003. 153,000 job cuts in October, up 175% from last year, up 183% from the month before. October's pace of job cutting was much higher than average for the month. Some industries are correcting after the hiring boom of the pandemic, but this comes as AI adoption, softening consumer and corporate spending, and rising costs drive belt tightening and hiring freezes. You can see the pop up here. This is Doge up here, and here is the jump up for October, and this goes all the way back to July of 2022. Worth reading some of this stuff here. 1.1 million jobs. Up 44% from all of last year, up 65% for the first 10 months. But if you control for Doge, the 300,000, you get slightly more in 2025 than 2024, but certainly not these numbers. So you could say, well, let's adjust for Doge. On the other hand, you would say, no, these are people who have been separated from their paychecks. They have lost jobs. If we're measuring the impact on the economy, it should be everyone for whatever reason, whichever way you want to see the numbers. This is underreported as well. Not only did individual companies announce large layoff totals in October, but a higher number of companies announced job cut plans. So those aren't layoffs yet. A layoff is we're laying off this many people. Job cut plan is we think we're going to reduce our labor force by this much in the next quarter or the next month. October's total is the highest for the month since October 2003, when 171,000 cuts were recorded. I don't like this comparing nominal numbers over time without normalizing them. You don't have a constant denominator. The size of the labor force in 2025 is much larger than the size of the labor force in 2003. In fact, if we go back to, if we go back to ADP will give us something here, right? Let's go back to 2000, look at here, 2010. We'll just use ADP's numbers, private payroll. You're up about 135,000 now, right? If you go back to 2008, we don't have 2008, but go back to 2010 over here. You are 106, and here's 135. So 1 million out of 135 is not as great an impact on the total economy as 1 million for 109. Now go back from 2010 to 2003. So a statement like this, a statement like that of it's the highest since 2003 on a nominal basis, but adjusted by dividing by the size of the economy, and I think you'll find 2003, that having 174 in 2003 as a percentage of the labor force was a much bigger impact than it is today. So I'm not a big fan of that. It's just what would you call it, data porn. It talks about which sectors saw job cuts, but we can let's just go right to hiring plans here. Through October, U.S. employers have announced 488,000 planned hires, down 35% from the 750 announced at this point in 2024. Now again, that's a worse number because you have to divide it by the size of the labor force. So what it's saying is, 488,000 divided by the size of the labor force is a much smaller percentage than 750,000 last year divided by the size of the labor force last year. So that's a bigger deal. Lowest year-to-date total since 2011, when 459 new hires were planned. And again, 459 divided by the size of that economy is a bigger percentage than this. So on an adjusted basis, the layoffs aren't as bad as the same quantity 10 years ago. But the hiring is much worse than the same quantity 10 years ago as a percentage. So yes, there are layoffs happening, but not as bad as history would say. You can't compare those numbers over time. But job hiring, almost non-existent. Let's look at some tables here. I've got some notes. We're going to look at 1, 2, 3, 4, 5 tables. Page 5 here. Government, as you would expect, that was the big number there, 307,000. Technology is big, but it's always big. Look at last year, 120, and this is a year-to-date 141. I'm not going to get excited about that. This is where it's a really big number, 90,000 versus 18.9, and 88,000 versus 36. This is warehousing and retailing. This is in the value chain on the way to the consumer. But I do have to ask, this was during the month of October. The shutdown started October 1st. That by the time you got to October 15th, maybe some businesses saw that it was this is going to take a while. October 20th, this is going to take a while. How many in the warehousing and retail, how much of that is a result of this government shutdown? as opposed to just the natural economy underneath. Now, the government shutdown is creating a problem in the economy because when you take several 100,000 people and you separate them from their paychecks, it's going to have a ripple effect in the economy. When businesses, I lived in Windsor for a long time, when an auto company would go on strike, the surrounding businesses around them would also lay off people and close their doors, especially the restaurants around there that relied on a lot of that traffic for their revenue. So it had these spillover effects, right? The government shutdown is an economic weapon. It's a bomb that goes off, and it's not just going to hurt the people that are separated from their paychecks. It's going to hurt everyone else. And if the consumer, which these people are, is 70% of GDP, you would expect to see that. So I question these numbers, saying, well, how much is a response of that? Services, 63,000. Month by month totals. January 20th was the new administration. That's when the government job cuts started happening at a rapid pace. But it continued on. May, 93 over 63. June settled down a bit. July picked up, 62 over 25. August was 85 over 75. September, a little lower, 54 72. Some hope in September, saying, oh, well, maybe the worst is over. And boom, how about that for the worst being over? 1.1 over 761. 1.1. District of Columbia taking the brunt of it, 303,000, right? District of Columbia. I wonder how many stores are shut down now. That was page 5. Let's go to page 8. 5. This is page 6. I do have 6 in here. This is by industry. There's your government right there, 307. So if we, this was 37 last year. So 270 is the difference. Let's take 270 off of the 1.1. You get to 830 versus 664. Still elevated for year to date. Still above last year. Next, we're going to page 8. This is the reason why. Here is AI down here. Where are we? Artificial intelligence, 48,000. Doesn't seem like that much, 48,000. Now, I know what this stuff can do. And if it's only 48,000 now, that means the worst is yet to come. I heard a number this weekend on one of the podcasts that I watch. I just sort of cycle through a bunch of them. Something like 10% of large companies have adopted AI to any significant degree. So if only 10% have adopted and 90% haven't, this is not a choice of saying Bitcoin, you know what, it's not my thing. Where you can go about your life for 15 years, never have Bitcoin or blockchain in your life and experience no disadvantage at all. Maybe even an advantage for not losing money. But this is not one of those things. This is not a blockchain where 15 years from now you could say, I don't see the thing of this AI. I don't get it. Adopt it or suffer a significant disadvantage. That's what it's going to be. So if only 10% have adopted, and you're already seeing AI, this is number 6 on the list of reasons why, you're already seeing it there. What do you think is going to happen in the future? Why central banks are not even talking about this? The Fed is not even, in all the talks everywhere, not even giving a head nod to this, to me, is completely oblivious. 48,000. Market economic conditions, that's the one to look at, 229,000. That's usually number one. And then, of course, you have the closing, the restructuring, the cost cutting. That's all up there. But AI to be named. How much of the cost cutting and restructuring in there is really AI, but is a combination? It's like, well, we're going to restructure, and AI has done a lot for us, but we already said we're restructuring, so your job is being lost to restructuring, not AI. This was page 8. We have 9 and 11. Page 9, this is quarter by quarter. And again, I don't like this chart because people will look, this is 946 for the first 3 quarters. We know that we have the month of October in here, which is in here. So this is 1.1. They'll just scan going 1.1, 1.1. Well, that's the same as 2008, 2009. And after the dot-com boom, we're already there. But hold on a minute, Frank. This 2 million over here in 2001 was a big deal when you divide it by the size of the labor force. Big deal. 1.1 million divided by the size of the labor force today is not the same as 1.1 million divided by the size of the labor force in 2008 or in 2001. So I really wish they would have had another column that normalized for it and then said this is the worst economic impact since. How big of an impact is this? You know, if you have 100 people lose their job out of a labor force of 200, that's a big deal. But if you have 200 people lose their job out of a labor force of 20,000, that's not as bad, even though the number is double. I think you get that, right? You're all smart people. And one more, page 11 here. Let's just do this one here. Announced hiring plans. This I think should have gotten more attention. Total year to date 488, and if you look, this is a big deal because when you go back to 2018, 2019, the size of the labor force was much smaller. So you have 1.2 million divided by a smaller number than 488 divided by a bigger number. So hiring plans, you can say here, have really dropped off a cliff if you normalize them for the size of the population. That's a big deal. Where's the growth in the employment going to come from? If you don't have growth in employment, you don't have growth in household income. You don't have growth in household income, you don't have growth in GDP. Now, I know the administration likes to say $20 trillion of investment has been announced. I think that was the last number. It just grows overnight, by the way. It grows with interest. $20 trillion have been announced. They're going to be investing in our economy over the next couple of years. Let's say they do it over 2 years. 20 trillion over the size of the economy. That means that the Trump administration is forecasting, just from investment alone, 25% GDP growth year over year for the next 2 years. So there should be a lot of hiring plans announced for that. A lot. Nope. It is the worst in at least this table going back to 2016, the worst for hiring. This is the monthly average: 73, 91, 84, 100,000, 1990, 265, 146, 123, slowing down, 65, 64, dropping, 48. Now, your denominator is growing over time. So if your numerator is shrinking while your denominator is growing, your normalized ratio is getting smaller and smaller. This is bad. But everyone focused on the 1.1 million. But if you divide it by the size of the population, it is not as bad as this. This, to me, is the big number to look at. And finally, 11 here, announced hiring plans. This is odd, right? Let's look at October. And let's go down here to technology, 250,000. 250,000 announced. Year to date, 257. So there was only 7,000 before this number. That's a huge jump in the number. This is year to date, October for 2024, only 14,000. Technology. There's AI. There's where AI is creating the jobs. Year to date, 250,000. Year to date, the economy has shed 1.1 million with the slowest hiring ever. It is really going on in one sector, which is data centers and AI. 250,000. This is available on their website. If you go to their website, you can download this PDF and you can go through it. 13 pages. You can go through it with a bit more detail if you like. Okay, let's have a look at the effect of all of that on rates and yields by the end of the week. Look at that. This is where TLT lives. Just not a friend to TLT. I am giving this till the end of the year. And where I'm in tax regimes, I am going to tax loss harvest this and move into U.S. Treasuries. TLT for the week down 0.8%. We did have rates and yields pull back on the curve capital market and money market. The upcoming FOMC still only sitting at 67%. Based on the jobs market, it would seem to me that a rate cut is in order. But based on this Fed And based on the statements last week, kind of looks like a coin toss. You have shut down in day 40. You have no economic data. They're in a, quote, fog. And when you're in a fog, you slow down. Nice analogy. So if we get nothing, given the nature of this Fed, I would say they're probably leaning to no cut. And it should be a cut, but there we are. 66.9, up from 63, slowly getting there, but that's just the market saying we think this. I think right now it's a coin toss, 50-50. We do get summary of economic projections for December. I don't know that as we get closer to Trump's pick, any of this means anything. And I do have a nice treat here this week. I used DeepThink, and I gave it all of the names that are being considered, and I gave it the scenario. And I said, who do you think is the most likely to be picked based on what we know about the players involved? We'll see that. You got a lot of Fed speak this week. There's Schmidt again. He's got a lot of explaining to do. Repos, $2 billion. It had, the day before was zero. So it has been dropping down. Reverse repos, $4.9 billion. That has been coming down as well. Reserves, $2.85 trillion. This is balance sheet runoff ends December 1st. And don't know if you heard Williams last week suggesting that the central bank will start to buy, or will have to start to buy, securities soon. However, not for the purpose of stimulating the economy, but just because this to them is becoming troubling. Is that why would anyone use it? You have excess liquidity. What's going on here? Why would anyone use it? So it must be that reserves have gotten a little too low. So he suggested that there might have to be some bond buying to bring the level of reserves up. TGA is doing a lot to take reserves out of the system because they're not paying employees. If they pay employees, it goes into their bank account. If it goes into their bank account, reserves go up, the TGA goes down. But because you're not paying anything, TGA goes up, reserves go down, 942. So you could probably fix quite a bit of that by simply just paying people. For the week, as I said, TLT down 0.8, SPX down 1.63. So I guess for some solace, I could say TLT outperformed. Dollar index up 0.77. Gold unchanged, really, down 0.01%, but you got to dig, you got to round up to get to that 0.1. Let's have a look at the term structure for Fed funds futures. Q4 pricing in 17.5 cuts. There's your 70 versus 30%, or 2/3 versus 1/3. You're 66% of the way there. Q1 pricing in 19.5, Q2 21, Q3 17, basically 75 basis points. That's over 7 meetings, 3 cuts in 7 meetings, and 3 of them are without Powell. Just doesn't seem logical to me. And I really don't think that Trump is going to wait, from the time that he gets control of the Fed, say, well, let's give it 5 or 6 meetings before we really cut rates. It's going to be out the door. 50, 75, 100 basis points out the door. If not out the door, it'll be a major makeover of the Fed internally, a partnership between the Fed and the Treasury, which I've said should really be in place, because they can both solve their problems with the MBS and the 10-year yield. They can both solve their problems, but it will be fast. Going a little bit further, April 2027 ended at 97, implied rate of 3%. We're at 3.87, so 87 basis points. That's basically 3.5 cuts in 11 meetings. 7 of those are a Trump-led Fed. So my positioning so far, this is the October 2026 ZQ. I have 332 of those. Move to the December 2026 ZQ. I've got 30 of those, and I got 50 contracts in the April 2027. Each contract is got an underlying of 400,000 in terms of what the interest rate is calculated on. So I have 400 412 contracts times 400,000. I think that's somewhere around 160 million on underlying. Oof. Try sleeping at night with that. But this one here, to me, seems like just an obvious thing to do. April 2027, you're at 97. You're telling me you're not going to get 3 cuts in 11 meetings? With 7 of them under Trump, at least 3 cuts? My downside, I think, is 0. And my upside is incredible, but my downside is 0. I think the target on this is 98. Across the board, I think they're going to run to 2% as quickly as they can. Real yields all have ticked up a couple of basis points. Inflation expectations have sort of ticked down a couple of basis points. And corporate spreads widening, but that is only till the Thursday. That doesn't include the Friday, right? So keep that in mind. But all of them widening. The 30-year mortgage up this week, 6.22, up 5 basis points. Mortgage apps for October 31st, ending the week of October 31st, down roughly about 2%. And issuance, we're going to look at a couple of infographics here. We're going to look at, I wouldn't call them infographics, but neat little charts. We're going to look at one for issuance, and we're going to look at one for interest expense. Year to date, up 8.8%. Issuance year to date, year over year up 8.8%. Issuance has been almost $2 trillion this year. And for October versus October last year, 150 on investment grade versus 103. So that's up about 50%. High yield 19 billion versus 25 billion last year. So high yield is sort of down this year. And convertibles 10.6 versus 10.3 is about the same. So it is investment grade that is finding a market. I'm going to show you issuance here shortly that combines all issuance in the U.S. And we're going to see September and October, huge months in terms of issuance of how much, just the sheer amount of debt that's going out there. Total U.S. federal debt is 38. We're now over $38 trillion. 38 trillion. 30.59 is public. 7.46 is intergovernment. So if you look at the Fed's balance sheet, it has what, 4.6 of that 7.4 trillion. 2.1, 2.2 trillion is MBS. And then you look at other government departments that are holding U.S. Treasury, Social Security being a big one. So that's the government borrowing from itself and owing itself money, 7.46. So the 30.59 is what we pay attention to. But interest is paid on the full amount. Because if it's sitting in Social Security, the taxpayer does have to return the money it borrowed to Social Security plus the interest component. Notice I didn't say the government because there is no government spending. It's all taxpayer spending. The taxpayer owes $38 trillion. And the taxpayer does have to pay interest on that to everyone, even if it is to the government, because the government doesn't borrow from itself. The taxpayer is borrowing from itself and must pay it back. Here's the average interest expense, 3.355%. So 1.27 trillion in interest expense. What is going to the public is 1.02. So you can say, well, you know what? We're giving them that money, but we're taking some of that back in taxes. So because there's interest income, there's taxable income, which means we're getting some of that back. So net on net, we're not really parting with that much. A lot of that is held in tax deferred accounts, however. Or tax-exempt accounts in endowments, in foundations. So maybe the tax haul from that isn't as great as just the raw number would suggest. Absorb that for a minute, 1.27 trillion, and you're running a deficit now of 1.8, 1.9 trillion. How much could a zero rate on money market save? Even if you get down to 2% and you start issuing all of the debt in money market securities, because the Fed did say they want to lower their duration, so that's one thing they have in common with the Treasury. I don't see that you have a choice but to get the interest rate down, because you can't afford $1.27 trillion. Now, if you don't get it down, that $1.27 trillion over the next year adds to the 38. It'll add to the 38 along with another $2 trillion in deficit spending. By this time next year, you'll be looking at 40 to 41 trillion. And if you don't get the rate down, then this will be 1.35 trillion. On top of that 41 trillion, with another $2 trillion of deficit spending. By the end of Trump's term, if this continues on, you can see the deficit being somewhere around 46, 47 trillion dollars. It's a path that you can't come back from. So I agree with Powell on this one here. The path that the U.S. is on is an unsustainable path. The levels right now are not unsustainable, but the path is unsustainable. And everyone's got a part to play. So maybe the government shutdown is welcomed from both sides, because maybe everyone recognizes we got a debt problem. But I don't want to make the tough decisions by laying people off. Trump did. But maybe other politicians say, I can't cut spending in my district, I won't get reelected. I can't cut people in my district. But what if there was a shutdown where everybody could blame everybody else and it would be plausible? And then we could just say, we're solving a lot of problems right now. So do you think this 40-day shutdown is going to be solved tomorrow? I don't think so. I think it's in everyone's best interest to let this go as long as possible, because you want to get the size of government smaller, separate people from their paychecks for an extended period of time. They'll find another job. They'll leave. They'll find another job. Maybe 1%, 2%, 3% of everybody from the government has decided, enough of this, I'm going to go find another job. These clowns aren't going to get anything solved. They're getting paid. They don't care. Or maybe it gets solved before the big holiday travel season, because, well, all these representatives, they got to get back to their districts, and you got flights being canceled everywhere. Unless there's enough private jets to take them around. Who knows? Let's look at a couple of charts. Okay, this first one, I'm on the SIFMA website. Fixed income issuance, all months. This is October. $1 trillion of debt issued in October of 2025. In 1 month in the U.S., $1 trillion was issued. This is just the U.S. Municipal securities, $56 billion. Treasury securities, $387 billion. $387 billion, and the government shut down. So the spending isn't happening. So the issuance doesn't have to keep up with that. Federal agency securities, $155 billion. Asset-backed, $43.5. Mortgage-backed, look at that, it's still alive there, $177 billion. Corporate bonds, $178 billion. Total issuance, U.S. only, $1 trillion. $1 trillion. Look at September, $1.25 trillion. September, big number. October, big number. You can go to all years as well. You can see there's the pandemic years. Look at the amount that's being issued here. If you take out the pandemic years, it is the high, going back to 2010, issuance for, this is 2024, has been the highest, and 2025 is running above 2024. Isn't that incredible? 5-year intervals. This is, again, going back to 2010. Your pandemic is in here, but here you are. Let's look at how much all this is costing. This is just government debt, by the way. Interest expense and average interest rates on the national debt. And this is 2026. The 2026 fiscal year for the U.S. begins October 1st. Their year goes from October 1st to September 30th. So Q4 is actually, if they were a company reporting earnings, this calendar Q4 is their Q1. So for 2026, you only have 1 month in there, $104 billion. But you can do a run rate, an easy run rate, multiply it by 12. If you're not going to forecast forward any rates, multiply by 12, you're still 1.2 trillion. You're still going to be up at this $1.2 trillion level. This dotted line over here is the average interest rate. Look how it fell down here into 2020, 2021, and here we are up here, 3.355%, 3.355. And there is your interest expense from last year, 1.22 trillion. To put it in perspective, let's just go back to 2020, 523. More than double from 2020, more than double combination of higher interest rate and higher debt. That is unsustainable. The U.S. doesn't have the runway to afford 1.22 trillion in interest expense going forward. I don't see a choice but to lower that rate. And Bessent wants a tighter integration between the Fed and the Treasury to coordinate strategy. The Treasury has to issue and has to pay all the interest on this debt. It'd be nice to have zero interest rates on money market funds if you're forcing people who are issuing stable coins to hold those T-bills. Why pay them anything? It's the deal, right? I think the new head of the Fed is going to be chosen in part based on their ability to recognize that this is a problem, that this is tomorrow's problem, and the Fed must include this in the way they think today. They must include this. This is a big deal. Okay, AI Corner. I asked DeepThink this question. I'm going to show you the question just so you can see that I'm not leading. I want you to forecast which person Trump will select for Fed chair from the following list. Christopher Waller, who is a current Fed governor. Michelle Bowman, who is Fed governor and vice chair for supervision. Kevin Warsh, former Fed governor. Kevin Hassett, White House National Economic Council director and close Trump of ally. Rick Reeder, BlackRock senior managing director in fixed income. And I put Treasury Secretary Scott Bessent in there, even though he's not on the list. You never know. Assess what Trump most wants, the types of selections he has made to other positions, and the willingness of each of the people listed to defer to Trump. Bessent made public statements about what he would like to see happen at the Fed, and he is conducting a second round of interviews in early December. Assess who he is most likely to recommend to Trump. Anybody got their guesses between all of these? Last week I said Rick Reeder or Scott Bessent. DeepThink did not agree with me, gave me someone else and gave me something to think about. And I thought, I haven't looked at that person very much. Let's have a look at them. So I will modify my choice to include the third one. I'm not going to get rid of the other two. I think they're equally likely, but let's put the third one in there. Who do you think it is? Let's find out. The analysis forecasts President Donald Trump's selection for the next chair of the Federal Reserve, evaluating the provided candidates based on the administration's priorities and the significant influence of Secretary Scott Bessent. Kevin Warsh is the most likely selection. His explicit calls for regime change and a new Treasury Fed accord, uniquely aligned with the administration's desire for lower interest rates and a fundamental overhaul of the Federal Reserve's relationship with the executive branch. The deciding factors: loyalty, low rates, and institutional control. The selection process is driven by the priorities of President Trump and the vision of Treasury Secretary Scott Bessent, who is leading the search. President Trump prioritizes loyalty and deference in his appointments. That is true. His historical pattern, particularly his contentious relationship with current chair Jerome Powell, demonstrates a demand for a Fed chair who will aggressively lower interest rates and align monetary policy with the White House's economic agenda. Trump frequently challenges the norm of central bank independence, seeking greater control over monetary policy. Secretary Bessent's influence. Scott Bessent's recommendation will be crucial. He shares the president's desire. Well, I'm going to take issue with the word shares. I don't know that Bessent shares anything with the president. I think he echoes the president and that's it. I don't think that Bessent has an independent thought that isn't the president's. He echoes the president's desire for aggressive monetary easing. Bessent recently argued that high interest rates may be causing a housing recession. Well, duh, right? And has publicly called for accelerated rate cuts. Furthermore, Bessent seeks institutional reform. He has criticized the Fed's mission creep and expressed skepticism about the overuse of quantitative easing, arguing it should be used sparingly. That is at odds with my prediction that the Fed will have to massively increase the size of their balance sheet. Bessent desires a Canada committed to structural change and closer coordination between the Treasury and the Fed. Here's the assessment. Warsh, alignment very high. Warsh has publicly criticized the Fed's hesitancy to cut rates and supports lower interest rates. Deference, very high. He has explicitly stated that Trump is right to be pushing the Fed publicly and called for regime change. Reform, high. Warsh is the strongest proponent of structural change, advocating for a new Treasury-Fed accord to formally coordinate policy with the Treasury. This directly addresses the administration's desire for control and Bessent's vision for a redefined relationship. He also aligns with Bessent by criticizing the Fed's mission creep. Kevin Warsh, I'm going to have to put him as one of the three. Christopher Waller, his alignment is high. His deference is moderate to high. Strategically supports the administration by arguing the Fed should look through the inflationary impacts. However, he is an institutionalist who has also reiterated the importance of Fed independence, reform low. He has not called for structural overhaul. Kevin Hassett, alignment moderate. He supports the administration's agenda but is less vocal on specific monetary policy than others. Deference, questionable. Don't know about that. Possesses the highest degree of personal loyalty as a close ally. Hassett has made forceful public statements in September 2025 that the Fed needs to be fully independent of political influence, including from President Trump. Ooh, and he still got his job? His wife isn't being investigated for some crime that she committed or may have committed? Ooh, you don't do that standing next to the king. This public defense of independence is a significant liability. Yes, it is. Reform, moderate. Rick Reeder, alignment, very high. Most dovish candidate recently stating the Fed funds rate should be around 3%. Should be around 3% now. Not will be, but should be around 3% now from 3.87. I agree with that. Well, I agree that it should be lower than where it is. Maybe I haven't done enough thinking to get to the 3%. My thinking is it should be at least 50 basis points lower, so 3.37 in the neighborhood. Deference, unknown. No government track record or established loyalty to Trump. Reform, moderate. His strong support for QE during crisis may conflict with Bessent's skepticism over its overuse. He would be more than likely, or more likely, to increase the size of the balance sheet without much prodding. I wonder if they can all see that that is probably what is going to be needed. But it's the deference that's the problem. Will he show loyalty to Trump? Bowman, alignment moderate, deference moderate. Scott Bessent, unlikely. He's leading the search, and President Trump has indicated Bessent wishes to remain at Treasury, but that's never been an issue for anything. You never know. So I'm still going to keep him on the list. Decision hinges on balancing the desire for aggressive policy, favoring Reeder or Waller, with the demand for loyalty and institutional control, favoring Warsh or Hassett. Bessent's likely to recommend Kevin Warsh. Bessent seeks a fundamental overhaul of the Fed, closer coordination with the Treasury. Warsh is the only candidate offering a concrete mechanism, the Treasury-Fed accord, to achieve this. Trump's most likely selection, Kevin Warsh. While Kevin Hassett offers personal loyalty, his defense of independence is problematic for Trump. Christopher Waller offers policy alignment, but not the structural change desired. Kevin Warsh provides the optimal combination. Well, you have round 2 of these interviews going on. And if you want the job in round 2, that's the time to say, no, you know what? I've reflected on it. Trump is right about everything. And I welcome his guidance and his leadership. And I've thought about it, and you're right. The Fed and the Treasury should be working closer together. They really should be working. If you want the job, there are words that you can say. Let's see what happens. We'll find out I believe Besson said before Christmas there'll be an announcement. So what do we have coming up? We have the big Fed announcement coming up of the rate cut in December. Are they? Are they not? And then you have this big announcement. I think this will overshadow whatever the Fed does, whoever it happens to be. And the big thing affecting markets, the other big thing, this is one. Number two, earnings are over. Earnings are over and we're not getting economic data. The shutdown is the shutdown. It is what it is, but AI is the bigger deal. Let's have a look at SPY. Let's have a look at SPY. Did not take out, none of the indexes took out any of their all-time highs. October 29th for SPY 687, we're now down 2.4%. IWM 250 set on October 15th at 241, down 3.5, and Triple Q 635 also on October 29th to match SPY 609, down 4.1%. That is sort of an AI-led question. Have we gone too far? Is the valuations too rich? Where is all this money going to come from? All these hundreds of billions, even trillions of dollars that this company says they're spending with this company, that says they're spending with this company. Last week I laid out the argument that it is coming from the shareholder, disguised as revenue. Because instead of me issuing my shares and you issuing your shares, let's do business together and I'll issue your shares and you'll issue my shares and we'll just declare it all as revenue. All of these circular deals are capital raises disguised as revenue. Revenue to support the price, capital raises to support the CapEx. That's where it's coming from. It's a good old-fashioned capital raise with the alchemy of disguising it as revenue. But have we gone too far? And that was the question all week long. Maybe it is a bubble. I heard one argument of it not being a bubble is because companies are not issuing shares. This was somebody put that on Discord. There was a link to an article that somebody wrote saying, well, companies are not issuing their own shares, so it's not a bubble. Well, they are issuing shares. They're just doing it in a different way. So what do I think about that? I think the euphoria got a little bit too far, and a lot of things are being priced in way too early, and a lot of companies are going along for the ride that probably shouldn't. So there should be some kind of shakeout. There should be some kind of take profit, but this is not over at all. That if we think that AI's trend looks like this, the market was getting a little bit frothy on this, but this will continue on. So even if it just went sideways from that point, it would still at some point have to increase. So even if you have a slight pullback, the AI trend is strong and continuing to grow, and I think growing faster than the overall economy and probably the fastest sector out there. It's the fastest adoption of any technology ever. And it is a technology of which, as I've been using it, is probably the most effective and productive I've ever used ever. When the internet first came out, I thought, oh, this is neat, but like, what would I use it for? You know, the email was really neat. That was kind of cool. Okay, this is great. But it was still a big question of, well, am I really going to shop online? It took me a while before I bought my first thing online. I wasn't one of the ones in 99 or 2000 saying, oh, this is great. I don't have to go to the supermarket anymore. Never did any of that. Blockchain and all the cryptos that came out, never got on board that because I just couldn't see the purpose. Cell phones, yeah, I bought, but in the beginning they were okay. Till you had digital phones. Originally they were analog, then they went digital, and they were still okay. They weren't smartphones like they are today. That came in time. The whole social media stuff that first came out, I had Facebook when it first came out, and I thought, well, what do you use this for? It seems like a big colossal waste of time to me. And being here, and you know, people that you knew 10 years ago are reaching out, clicking, saying, be my friend. And people that you 10 years ago, you thought, I really never cared for you that much to begin with. Just because I'm here doesn't mean I want to hang out with you. I got rid of it. But this AI thing, no. It is real. I've heard some people say that the market is underestimating its true impact. I think that's right. I think everyone is underestimating what this thing is going to do, including to the job market. But this is not over. This is a whole new industrial revolution. It's a whole new layer to the internet. Social media was another layer to the internet. This layer, I think, replaces the first layer. So that sets up the trade desk, which is a company we're going to be looking at. And we're going to see how AI threatens, I think, basically the existence of companies like the trade desk. That's the big question. In fixed income, the big question is who's the next chair of the Fed and what the hell are they going to do? And in equities, it's what's going on with AI. Is it really bigger than what we think? Are we pricing in too much? So it's healthy to question this stuff. Forward earnings, 295, closing SPX 667.28, forward multiple 22.75. We've peaked over 23 a few times now, and every time you've peaked over just a bit, smacked right back down. And then the market just comes right back up to the 23 and smacked right back down. There you go. I think that's a triple top at the 23. We are at 23.2 last week, well below it this week. The next one, I think you run right through. Imagine 24, 25, 26 times forward earnings. IVP, I don't have it for you this week because Interactive Brokers was down all day yesterday. I do my screens on Saturday, then I narrate on Sunday. I started narrating, looked, oh, I don't have it. I should stop, re-log in, get the numbers, put them down. I'm too lazy for that. So this week you don't get them because I am lazy and I'm not going to do it. Let's have a look at earnings. Nothing really much this week, depending on who you look at. Under 10, over 10, who the hell cares anymore? This is just S&P. There are a lot of companies reporting. A lot of companies in the crypto mining space, in the Bitcoin mining space, are reporting this week as well. A lot of high volatility companies are reporting that if you are a volatility trader, you'd recognize pretty much all the names on the list. They're reporting this week. So in that space, there's some volatility. But there's so much volatility, would you even notice the volatility from the earnings? I don't know. Oxy on Monday. Let's see what they say about OxyChem. Cisco on Wednesday. You have Disney on Thursday and Applied Materials on Thursday. Let's look at the trade desk. Okay, the trade desk. Let's situate them in the industry that they're in. Digital advertising. And I've got a PDF going up this week for understanding digital advertising. They're in the communications sector in the advertising sub-industry. So there'll be, I think it's about 60, 70 pages. And through it, I tried to put as much about the trade desk in as I possibly could. Whenever we talked about DSPs, I primarily leaned into the trade desk because they are the largest demand-side platform and one of the few pure plays that you can actually get access to publicly traded. Largest in the world, programmatic bidding. So they have a platform where advertisers show up and they say, I want to spend $1 million. And the trade desk then finds places on the open web for them to be. Open web, we'll talk about walled gardens and open web here in a minute. They provide software and optimization services and they charge fees as a percentage of ad spend. So you want to spend $1 million, that'll cost you $150,000 at the low end at 15%. So that's where they make their revenue. They don't hold any inventory. Inventory meaning we have spots where you can advertise on. Whereas when you go to Google and you are an advertiser and you want to spend, you're buying their inventory. Well, we have a space here you can advertise on. You can advertise here and here. They hold no inventory and they pay no creators. You advertise on YouTube, Google takes your money, but then pays some of it out to the creators. So their revenue is how much the ad spend is, less how much they pay out. For the trade desk, their revenue is just the commission on the ad spend, not the ad spend itself. Just to put that in perspective. They got added to the S&P 500 July 18th, 2025 at $80.21. given their current price. They are down 45% since they got added to the S&P. They hit an all-time high on a closing basis on December 3rd, 2024, not even a year ago. 139.16 on a closing basis. I think they hit 141, 142 on an intraday basis. They closed at 43 on Friday, down 68.8% from their all-time high, down 45% from the time they were included in the S&P. Earnings ugly, earnings ugly. And they had earnings again, and it was mixed. It was like, is this good? Is this bad? Growth is moderating, not good. A focus for companies like this, you can focus on one of two things. You can focus on revenue or you can focus on EBITDA. This should be familiar if you're comfortable with Rule of 40, which is balancing growth with profitability. Anything over 40% when you add up your revenue growth rate and your EBITDA margin means you're balancing the two of them together. This company had super high valuations. I think within the S&P, probably the most highest valued per dollar of net income. What you were paying per dollar of net income was one of the highest. So even though they continued to grow, their growth rate is moderating. So their multiples are really coming down and coming down from a very high level. And in the end, you're going to have to determine whether you like the $43 price or not. We'll look at valuing it a number of different ways. Just to sort of set you up, it's important to understand the distinction in the digital ad space between walled gardens and open web. Walled gardens are companies like Google, Amazon, Meta, TikTok, LinkedIn, where they sell you their own advertising. You go to their platform and you buy their advertising. Joe's travelguide.com is not going to have its own marketing department, right? That's where the open web is. Millions of independent websites and apps, from major news organizations to bloggers, they're not big enough to justify their own marketing department. But these companies, Google, Amazon, Meta, especially Google and Meta, are advertising run businesses. That is their revenue. Amazon, I think something like $47 billion in advertising, but it's not their primary thing, but they do have a big market. For Google, search is the most profitable because they get revenue. They don't have to pay any intermediaries because they sell. Whatever the ad spend is, they get the ad spend. And then whatever it costs to put the ad in the page, it's pennies, really. But there is no content provider to pay. But for YouTube, they get the money for an ad that goes onto a video. First of all, it costs more to generate a video than a series of links. And then some of that they pay to the creator. So search is their most profitable. Meta is the most profitable per dollar of ad spend because all of the content created, the advertisers or Meta doesn't have to pay any of the content creators for any of that. So their per dollar of ad revenue that Meta gets, they are the most profitable in terms of what it costs them to put it up there. Walled gardens, about 60% of digital ad spend, and not available to DSPs generally. I shouldn't say not available. It is, but it's generally not available to DSPs. So they will, Google will sell everything it possibly can, and it may have a few little things saying, okay, well, we do have some inventory that's not sold. That may find its way into an auction that a DSP can bid on. It may find its way in there, but not the good stuff. Now that 60% is up from 40%, 50%, all the way to 60%. 10 years ago, I think it was around 45 to 50%. You're at 60%. They're gaining a larger and larger share of the market, primarily because of data restrictions. These guys have first-party logged-in data. So if I have a site and you log into my site, I have a whole bunch of information about you because of the way you use the site. But if I'm advertising or trying to advertise, and I'm advertising on sites in which I don't have that information, well, then I have less ability to target you. So it's more expensive to spend money on Google, Amazon, Meta, TikTok, LinkedIn, but they have better targeting than it is on the open web. Now, with data restrictions creeping in, more and more the companies like Trade Desk lack the ability to target the way the walled gardens do, so more money is shifting over to those types of sites. 35 to 40% of digital advertising spend. Privacy-driven restrictions on data collection and identity resolution degrade DSP targeting effectiveness, which means the ad spend is lower. And with fewer, with a lower ad spend and fewer people heading, fewer advertisers heading here, the size, revenue times quantity is shrinking quickly. Now, what has helped the Trade Desk is they've been able to grow through buying a whole bunch of the smaller DSPs that were less efficient. So their growth was not primarily organic, but was buying a whole bunch of these smaller ones. That's sort of run its course. So now you have to compete in a business in which margins are being pushed towards zero. If you look at the supply side, the SSPs, this is a demand side platform, supply side platform, their margins are much, much lower. DSPs are higher, but DSPs are probably going to head to the way of SSPs, which means that the combination of revenue growth, which is slowing down, and EBITDA margin will eventually drop below 40%. Which means even at the valuation it has today, it would still be considered overvalued if you think that's the way it's going. Let's dive a little deeper. We'll start with their market. United States, 86%, significant U.S. Exposure, and this is not a growth market for digital advertising. It is a big market. It is an expensive market, but it's not a growth market. The cost or the revenue that you could generate per ad in the US, I think, is almost 5 to 10 times the amount of an emerging market. So emerging market, a higher growth rate, but it's the ad spend is very, very low. Ad spend in US is high, but not a growth market. For the Trade Desk, their growth has come from taking share, from buying smaller DSPs and taking share. Just to give you an idea of how they operate, very comprehensive supply integration. So you have your demand side, advertisers show up here and say, we want to spend money. And then you have the supply side over here where you have publishers saying, we would like to make money. And then you have an exchange in the middle. The more supply connections you have, the greater the supply of inventory you have, the greater the selection for the advertisers are, the more likely they are to get a good campaign in that crosses a bunch of boundaries. The other thing that Trade Desk does is it buys a whole bunch of data from data providers because it has no first-party data. Now, some of these people show up with first-party data, and they have this thing called UID2 where they'll take the email address and they'll create a particular ID tag. This ID tag does not identify this person. So you avoid the data sharing aspect of it because all you have is a data tag. And then from all these data providers, it does the same thing. It creates all of these IDs. Well, when this ID matches this one from this source and this from this source and this from this source and this, you can then begin to create a profile of that individual person. That is the closest you're going to get. It's going to lack a lot of behavioral stuff, but it's going to have a lot of demographic stuff, age, location, things like that, and as much as they possibly can get out of that, out of piecing it together that way. But as far as, well, what pages did they click on? How long did they stay on that page? How much did they engage with it? What were their conversations about? Are they, leaning towards? Are they, where are they in their life? Amazon knows when you're about to have a baby, when you've had your baby, when your baby's 1 year old, when your baby's 2 year old, by the purchasing patterns that you buy on their site. So they know, hey, your baby's probably about 2. This is stuff that, a 2-year-old would normally have, and they know what stuff to put in your way. You don't have that here, but you are able to create some kind of profile. That's the best that you can get. So the better the supply integration you have, the more supply connections you have, an increase in supply connections. The more supply connections, the more purchasing opportunities there are. The more purchasing opportunities, the more advertisers you get. The more advertisers you get, the more data you get to improve your optimization. And their AI engine is KOA, I guess. Makes it the more data to improve optimization, the better the optimization, the more attractive it is for advertisers, and you get this virtual cycle. This creates a winner take most dynamic, and that's what makes the trade desk the largest one out there. So as far as an operation and the flow of value goes, you can't fault them for this. As far as management effectiveness goes, you can't fault them for that either. The problems with trade desk are primarily problems in the environment, and when it's problems in the environment, it's not as if we can point to something and say, well, operationally they're not doing the right things. Operationally, you can say that about some companies that have had problems in the past, that they're just not very effective at what they do. Bell Canada, I think, was one of those that operationally you could look at and say, well, you're making some bonehead decisions. They're not. It is the environment. This, by the way, is very sticky and has very high switching costs. So you tend to keep these. Their retention rates are about 95%. They barely lose anybody. Costco doesn't have retention rates as high as 95%. Trade Desk doesn't own any media or any content. It is simply just a demand-side platform. Google is one of their largest ad inventory suppliers. Google's a walled garden. They sell their advertising, but they don't always sell it all. So they're so large that they still end up being on the open web Trade Desk's largest ad inventory supplier. That is an opportunity and a risk. A risk because Google might be able to say, look, we can place it all now. We're just not going to give it to you, because if we don't give it to you, you're less attractive. That makes us more attractive. I don't know. Platform is omni-channel, connected TV, mobile, video, audio, display. Connected TV is small right now, but it is the fastest growing segment, somewhere around 15-20% growth. Trade Desk's reach, at least they claim their reach in connected TV, is 90 million households and 120 million devices. While advertisers that want to get that are redirecting their ad spend to connected TV, there is the winning spot here. So it's a matter of forecasting that forward and saying, well, that's probably going to be a big growth spot. And the UID2, I explained what that is. Open source identity framework is a replacement for third-party cookies. Let's have a look at the revenue. It is the gross spend. They have an advertiser that comes to them, says, I want to spend $1 million. It's 1 million times the take rate, which is their platform fee. This is 15 to 20% in there. So they don't recognize the 1 million as revenue. They say, you want to spend $1 million, we'll find places for you to spend that $1 million. It'll cost you 150 to 200,000. That is the revenue. The gross spend, the open web, this is a function of the open web ad spend. So if you have open web that is shrinking over time, because walled gardens are increasing over time, and if ad spend is not increasing by a rate faster than this is shrinking, then you have a shrinking market. Trade Desk represents 15 to 20% market share of the open web ad spend. Shrinking, the open web is shrinking to walled gardens. Advertising drops considerably in recessions, and the U.S. is a mature market of which they have 86% exposure to. So from an environmental perspective, doesn't look that great. Let's look at the revenue trend here. Well, not a trend, but year over year. They had been clocking in 25 to 30% growth year over year. That is now dropping. 2024, this is the 3 months ended. 2024, 2025, 17.74% growth. That is a significant deceleration from the growth that they used to have. EBITDA, if we look at their, let's go with the gross margin first. Just take out platform operations. Gross margin 78%. Last year was 80.5%. For the first 9 months, 77.8 versus 80.2. 240 basis points decline in their gross margin. So their revenue growth rate is slowing down. Under 20% is slowing down dramatically. And their gross margin is taking basis point hits. If we go all the way through to EBIT, they're sort of making it up in some efficiency in here. 21.8% versus 17.27 last year. For the full 9 months, 16.22 versus 13.6. And at the very bottom, I wrote in their net income, 115 million, up from 94 million. First 9 months, 256, up from 210. And here is the EPS, 24 cents. If I put 25% growth on that EPS and I calculate it out for the next 4 quarters, I get to about $1.20. I say that's questionable that they're actually going to get to $1.20 at a price right now of 43. That gives them a PE of 35% for what looks to be sub 20% growth. Price to sales 7.5x. If we look at it as a rule of 40, their EBITDA margin is 33%. This is taking their EBIT and adding back depreciation, amortization. You get to 33%. I'm not going to use adjusted EBITDA. Just going to use a pure EBITDA. And add that to their growth rate. You get to 50, down from 70. That is their growth rate and their margin. Regardless of what their stock price was, it was 70, because this doesn't include a stock price. It's just the addition of growth and profitability. 70 down to 50. I think that shrinks once you get below 40. When you're looking at high growth, high EBITDA companies, once you get under 40, you're either a low growth profitable company or a high growth somewhat profitable company, but you're not a high growth high profit company once you drop below that 40. And there's every indication that they are going to drop below that 40 based on this statement from their last 10Q. Starts, we invest for long-term growth. We anticipate our operating expenses will continue to increase in the foreseeable future as we invest in platform operations for our hosting capabilities, as well as technology and development to enhance our platform and related offerings, included our continued focus on the development and incorporation of AI. We also anticipate our sales and marketing expenses will continue to increase to acquire new clients and reinforce our relationship with existing clients. In addition, we expect to continue making investments in our infrastructure, including our information technology, financial, and administrative systems and controls. We believe markets outside the US, and in particular across Europe and Asia, in markets such as UK, Germany, France, China, Japan, India, and Australia, offer opportunities for growth. It doesn't say what kind of growth or better growth, but opportunities for growth. Well, of course, going into any new market will give you opportunities for growth. But the US is the most profitable digital advertising market in the world. Every other market is less profitable. The US is the most profitable one. We intend to make additional investments in sales and marketing and product development to expand in international markets where we are making significant investments in our platform and growing our team. This is the important line here. We believe these investments will contribute to our long-term growth, although they may negatively impact profitability in the near term. Negatively impact profitability in the near term. So your EBITDA margin is not going to stay at 33%. It's probably going to shrink from there. You are pursuing growth, so maybe you'll get some growth. Up from that 17% growth, you might get some growth, but at the cost of profitability. That's what the rule of 40 is capturing, right? Is that trade-off between growth and profitability. The higher you are above 40, you're not facing a trade-off. You're getting revenue growth along with profitability, along with big margins. That's a beautiful business to be in. But once you get to the point where, well, I can push one at the cost of the other, well, maybe you're not that high growth company anymore. So I question the 120 going forward. Negatively impact profitability in the near term. I question that 120. That probably closer to $1.10, $1.05, which means its price to earnings is probably much greater, even at 43, even at this level, even down 60-some% from their high they hit last December, still appear to be a very richly valued company. Okay, I want to, before we go here, draw your attention to the cash flow statement, specifically stock-based compensation. And I don't agree with the way that this is being treated, and I think that cash flow from operations should be adjusted for this. I don't think it should be added back. because it is compensation, which is an operations expense. All you're doing with stock-based compensation is moving cash flow from operations, is improving, or I should say, improving your cash flow from operations and moving it to cash flow from financing. Imagine if you could do that for a whole bunch of things you didn't like in operations, just move it to financing, right? You'd be showing great free cash flow, great cash from operations, but are you? This is what they say they use stock-based compensation for, used to attract engineering and commercial talent. Well, if that's the case, that is an expense of operations. Here is their share repurchase program. Look what they say here. Is designed to help offset the impact of future share dilution from employee stock issuance. So on my income statement, I'm paying you stock. But on my cash flow statement, I am buying back shares. I'm using cash to buy back shares. So just cancel out both these shares, and what do you get? You get cash. Here's some stock. You go ahead and you sell your stock. I'll use the cash that I would have given you, and I'll buy back that stock. Am I not just giving you stock but using the market giving you cash but using the market to do it? Again, this is financial alchemy, I think, that is allowing cash flow from operations to be higher at the expense of cash flow from financing, because who really looks and pays attention too much there? Platform operations. This is what it breaks down to. Share-based compensation, 26 million. Sales and marketing, 84 million. Tech and development, 123. And of course, management, right? 140. 37% of look at the size of this, 378 million. Look at your net income, by the way, 256 million. Share-based compensation, 378 million. 37% flows to management. And there you are, adding it back to net income to get this big cash flow number of 681 million. And repurchase of Class A common stock, 957 million. Designed to help offset the impact of future share dilution for employee stock option issuance. So what do you have? OPEX is showing up as a financing cash outflow. I think everyone should do this, is adjust your operating cash flow to account for share buybacks that are doing nothing but to immunize the share count. So if you adjust, and you're given all the numbers here, net cash provided by operating activities, take the 681, add the negative 957, add the positive 20, and add the negative 79, because this is taxes paid. Well, you got to pay tax. I give you these stock awards. I got to pay tax on it because that's the withholding. Had I paid you cash, that's the withholding I would have taken to give to the government. Kind of all looks like you're paying me by using shareholder money, doesn't it? Right? This would have been their cash flow from operations for the first 9 months of 2025, negative 335,000. And in 2024, 392 and not 540. If you adjust, if you say, look, this is just a fancy way of saying it's not going to show up as operations. How do we make our cash flow from operations look really good while continuing to pay our employees a market rate that is attractive? I know. Let's get the shareholder to pay for it, and we'll call it cash flow from financing activities as opposed to cash flow from operations, and we'll look really good. I don't agree with that. If you have stock-based compensation, I get that it's non-cash, but the repurchase of the shares under a stock-based compensation, if you're repurchasing the shares to keep the share count constant because of this, that outflow should be operations, should not be financing. And we'll end there on that diatribe I just did on this. But I just don't like the way that is set up, because it is an operating expense and they're just disguising it as a cash flow from financing to make the numbers look better because they think you're all that stupid. That's it. What would I do with Trade Desk? Nothing. I think it faces an existential crisis with AI, because what do you have coming up? Never mind the use of AI. Think about the AI companies and the size of them. Do you think OpenAI, they'll all have to adopt advertising at some point to afford what they're doing? They're all going to have to adopt advertising. If you're going to use the free version or the $20 a month version of ChatGPT, yeah, you're gonna be faced with ads. 800 million active monthly users. Do you think they're going to be a walled garden, or they're just going to be an inventory supply and say, okay, well, we'll live with auctions? They have logged in users, first party data. What do you think they're going to be? The big money is in having their own marketing. They're going to be a walled garden. And AI is already hurting independent websites who say search was their big reason, was the big reason why they got the traffic flow they have. You have some companies that are reporting a drop of almost 100% in traffic flow because of AI searches. AI is not URLs where you have to click on a bunch of things. Perplexity just gives you the answer that you want. You don't have to click on anything. So the click through to websites is dropping. Websites are disappearing or finding no reason for existence any longer, which means the supply on the open web is dropping. And the amount of inventory that's going to show up under walled gardens under AI is only going to increase. That 35 to 40% for open web over the next 10 years will drop probably to 20 to 25%. This is a shrinking market. So I do think it and going into other geographic markets are less profitable than the US, and they've saturated the US. They're as big as they're going to get in a shrinking part of the digital advertising market, which is the open web. I wouldn't buy this. I wouldn't sell a call on this either. And I wouldn't short it. I would just ignore it. There is no trade on this one. I always like to say companies are either a buy, a hold, or a sell, and there's always a trade on something. This is a solid hold to a slight sell. But I wouldn't waste my time with it because I don't see much opportunity here on this one. I don't know that they're ready to go to go lower, but if I had to price them at a place where I'd say, I wouldn't mind buying them here, it would be probably at half the price that they're at right now. Maybe $25, 25 to 30. I might think, let's sell a put at $22.50. Let's sell a couple there. Why not? Let's see if there's anything there. But overall, I think if you value this as a going concern business, I would have to say that if you're going to do a 10-year forecast and then you use a terminal value, which is their growth into perpetuity, I'd say their terminal value would be close to zero. This is not a 50-year business. In 50 years, this won't be around, so I don't know that you're going to have any terminal value on this. They don't pay a dividend, and their EPS is far too low. I just wouldn't touch this thing. That's it.